Technical analysis, or TA, is a tool used by traders to analyze financial markets. It involves studying historical price movements to identify patterns and trends. TA can be applied to various assets, including stocks, forex, and cryptocurrencies. Price reflects all information, including economic news and market sentiment. By analyzing charts, traders identify high-probability opportunities and manage risk. Candlestick charts are a popular type of price chart used by traders to visualize price movements over a specific time frame. Each candlestick represents the price action for a given period, such as 1 minute, 1 hour, or 1 day. Candlesticks provide valuable information about the open, high, low, and close prices for the chosen time frame. A candlestick consists of two main parts, the body and the wicks. The body represents the difference between the opening and closing prices. A green or white candlestick indicates that the closing price was higher than the opening price, suggesting buying pressure. Conversely, a red or black candlestick signifies that the closing price was lower than the opening price, indicating selling pressure. The wicks, also known as shadows, extend from the top and bottom of the body and represent the highest and lowest prices traded during the period. The upper wick shows the highest price reached, while the lower wick indicates the lowest price traded. Longer wicks suggest greater price volatility during the period. Candlestick charts are highly versatile and can be used to identify various trading patterns and signals. By analyzing the shape, color, and position of candlesticks, traders can gain insights into market sentiment and potential price reversals or continuations. Understanding trends, support, and resistance levels is crucial for successful technical analysis. These concepts help traders identify the direction of price movements and potential trading opportunities. A trend refers to the overall direction of price movement over a period of time. An uptrend is characterized by a series of higher highs and higher lows, indicating that buyers are in control. Conversely, a downtrend is defined by a series of lower lows and lower highs, suggesting that sellers are dominant. When the price moves sideways within a range, it is considered to be in consolidation. Support and resistance levels are price levels where the price tends to reverse or stall. Support is a price level below the current market price, where buying pressure is expected to be strong enough to prevent the price from falling further. Resistance is a price level above the current market price, where selling pressure is anticipated to be strong enough to prevent the price from rising further. Traders often look for breakouts above resistance levels or breakdowns below support levels as potential trading signals. These breakouts or breakdowns can indicate a shift in market sentiment and the start of a new trend. Section 4. Technical indicators and chart patterns. Tools for informed trading. Technical indicators and chart patterns are essential tools that provide traders with additional insights into market behavior and potential trading opportunities. Indicators are mathematical calculations based on historical price and volume data, while chart patterns are recognizable formations that appear on price charts. Technical indicators, average true range, ATR, measures market volatility and helps determine appropriate stop loss and take profit levels. Moving averages smooth out price data to identify trends and potential support and resistance levels. Relative Strength Index, RSI, a momentum indicator that identifies overbought and oversold conditions. Chart patterns, double tops and bottoms, reversal patterns that signal potential trend changes. Head and shoulders, another reversal pattern that indicates a potential trend reversal. Flags and pennants, continuation patterns that suggest a temporary pause in a trend before it resumes. Triangles, continuation or reversal patterns that form when the price consolidates within converging trend lines. Section 5. Risk management and Fibonacci retracement. Protecting profits and identifying opportunities. Risk management is crucial in trading to protect capital and minimize losses. Setting stop-loss orders and using the risk-reward ratio are key strategies. Fibonacci retracement helps identify support and resistance levels using ratios like 23.6%, 38.2%, and 61.8%. Combining technical analysis with risk management increases trading success. Always educate yourself and seek professional advice.